Gold just crashed 15%, falling from 1.9 lakh to nearly 1.5 lakh.
Now, Budget 2026 adds 12.5% tax on many SGB investors. Watch this gold exit strategy guide before you sell. One wrong move costs thousands.
Welcome back to the channel. If you are watching this, it is February 2026 and the gold market has just delivered one of the most confusing weeks in recent history. We are looking at a scenario that few anticipated just a few months ago. We have prices on the MCX that have swung violently, a union budget that has completely rewritten the tax rules for your portfolio, and major banking institutions suddenly stepping back from digital platforms. For the last 3 years, the narrative was simple: buy gold, hold gold, and watch it grow. But as of this morning, the rules of engagement have changed. Investors are seeing their portfolio apps flash red with a 15% drop in prices, and at the same time, they are reading headlines about new taxes on sovereign gold bonds. The question on everyone's mind is no longer just how much should I buy, but rather how do I exit without losing a fortune. Today we are going to break down the 10 critical exit strategies and reality checks you need to know right now. We are moving past the panic and looking strictly at the data. Whether you hold physical jewelry, SGBs, ETFs or digital gold, your next move needs to be calculated, not emotional. Let's get into the specifics of what has changed and how it impacts your wealth. Let's start with the most significant regulatory update from Budget 2026. For years, the sovereign gold bond was championed as the ultimate tax-efficient instrument. The premise was attractive: zero capital gains tax at maturity. However, the fine print has now been enforced with a new rigidity. The government has clarified that the capital gains tax exemption at maturity is restricted exclusively to original subscribers. This distinction is massive. If you were one of the many investors who purchased SGBs on the secondary market, meaning you bought them through your demat account on the stock exchange rather than during the initial RBI issue, that tax shield is gone for you. If you exit now or even hold to maturity, you must factor in a 12.5% long-term capital gains tax on your profits. This effectively kills the arbitrage trade where investors would buy discounted bonds on the exchange to enjoy tax-free returns. If you are holding secondary market bonds, your net return calculation has just dropped significantly. You need to adjust your spreadsheets immediately because that 12.5% tax liability is now a reality you cannot ignore. Now addressing the price action that has everyone worried. Late January and early February 2026 witnessed a massive flash crash. We saw gold prices on the MCX plunge from near record highs of 1.9 lakh rupees per 10 grams down to approximately 1.5 lakh rupees. When a drop of over 15% happens in days, the natural human reaction is to panic sell to prevent further losses. But if we look at the technical data, this looks like a classic correction, not a trend reversal. The crash was driven by heavy profit booking after the massive rally of 2025, combined with a sudden strengthening of the US dollar. Selling during a flash crash is often the fastest way to destroy wealth. Major banking institutions are still forecasting a recovery to levels above 1.75 lakh rupees later in the year. If you panic sell today, you are locking in a temporary loss. Unless you have an immediate cash flow crisis, the data suggests that holding through this volatility is the statistically superior option. For those who absolutely need liquidity, there is a much better option than selling your bonds at a discount on the stock exchange. We need to look at the SGB 2020-21 Series X, which was issued back in January 2021. Under the sovereign gold bond scheme, a premature redemption window opens after 5 years. For SGB 2020-21 holders, that window became active in January 2026. The Reserve Bank of India fixed the redemption price around 14,130 rupees per unit. This is crucial because the secondary market on the stock exchanges is currently illiquid and panic-driven. If you try to sell there, you might be forced to accept a price significantly lower than the fair market value. The RBI repurchase window, however, is based on the average closing price of 999 purity gold as published by the IBJA. It offers a fair exit mechanism that bypasses the market volatility. If you hold this specific series, check the RBI notification dates and use this official window rather than the open market. We must also talk about the shifting landscape of digital gold. Regulatory pressure has been mounting on banks to separate traditional banking from unregulated commodity products. A prime example of this was Axis Bank discontinuing its digital gold services on December 31, 2025. If you were accumulating gold digitally through banking apps and missed the notifications during the holiday season, you might find your access restricted. The gold itself is not gone. It is likely held by the custodian, such as SafeGold, but your interface to access it through the bank app has been severed. This means you may need to perform a manual KYC verification directly with the custodian platform to reclaim access to your assets. This is a wake-up call for everyone holding digital gold. Open your banking apps today. If you see a service discontinuation notice, do not wait. Your assets could be sitting in a frozen state, inaccessible until you complete the migration process. Let's move to portfolio strategy. 2025 was an anomaly where gold rallied approximately 70%. While high returns are great, they distort your asset allocation. If you originally planned for gold to be 10% of your portfolio, that massive rally likely pushed it to 15 or even 20%. This is where the 5-25 rebalancing rule comes into play. When an asset class exceeds your target allocation by 5%, it's a signal to book partial profits. This is not about panic selling, it's about discipline. You sell the excess 5% and redistribute that capital into asset classes that are currently underperforming or undervalued, such as specific equity sectors or debt instruments. This strategy ensures you are buying low and selling high systematically. It protects your gains from future corrections. If you are sitting on a heavy gold allocation, do the math. If you are overweight, take some chips off the table and diversify. If you have decided to sell, the instrument you choose to liquidate matters immensely for your tax bill. In the wake of Budget 2026, ETFs have emerged as the most tax-efficient vehicle for exiting into cash. ETFs held for more than 12 months are now taxed at the 12.5% long-term capital gains tax. Compare this to the cost of liquidating physical gold. When you sell jewelry, you're not just dealing with taxes. You're taking a hit on the making charges you originally paid, which can be up to 20% of the cost. You also lose the GST paid at purchase, and the buyer will likely deduct a percentage for purity verification. The transaction cost difference is stark. Selling an ETF costs you less than 1% in brokerage and spreads. Selling physical jewelry can cost you upwards of 30% in total value leakage. If you need cash, always liquidate your paper gold, ETFs or mutual funds before you touch your physical assets. Expanding on physical gold, there is one golden rule for jewelry owners. Never sell for cash unless it's a dire emergency. The secondary market for cash buybacks of jewelry is predatory. Jewelers will typically deduct 4 to 10% below the market rate if you want cash. The superior exit strategy for physical gold is the exchange scheme. Major retailers like Tanishq and Malabar offer 100% exchange value on the weight of the gold if you're upgrading to a new design or a diamond piece. By exchanging rather than selling, you preserve the entire value of the metal weight. You avoid the cash discount and the purity haircut often applied to cash transactions. This turns a potential loss into a value retention play. If you have old designs that you no longer wear, do not sell them for liquidity. Exchange them for modern pieces or bullion coins that retain value better. Indian investors often make the mistake of watching global news too closely. You might see headlines that gold has dropped $100 an ounce in international markets and panic. But you spend in rupees, not dollars. The domestic price of gold in India is heavily cushioned by the exchange rate. Currently, the rupee is trading between 90 and 92 against the US dollar. When the rupee weakens, it becomes more expensive to import gold, which keeps the domestic price high even if global prices are falling. This currency depreciation acts as a floor for your investment. It's a natural hedge. So, before you exit based on a statement from the US Federal Reserve, check the RBI's intervention in the currency market. If the rupee is weak, your gold price in India will remain resilient. Do not exit a rupee-denominated asset solely based on dollar-denominated charts. Finally, we must consider the argument for doing absolutely nothing. Despite the crash in February 2026, the structural drivers for gold remain incredibly strong. We are seeing central banks, including the RBI, continuing to accumulate gold reserves to diversify from fiat currencies. Institutional forecasts are predicting that gold could cross the $5,000 per ounce mark by late 2026. This suggests that the current drop is a temporary liquidity flush, not a fundamental breakdown. If you don't have an immediate need for capital, the best exit strategy might be no exit strategy at all. Selling into a dip during a secular bull market is a classic error. If you can withstand the volatility, the data points to a recovery that could eclipse previous highs. Patience in this specific cycle is likely to be rewarded. Before we wrap up, let's quickly debunk 3 myths that are causing investors to make poor decisions this month. Myth number 1. Sovereign gold bonds are always tax-free. We now know this is false. As of February 2026, the tax exemption
applies only if you are the original subscriber holding to maturity. Secondary market buyers, please calculate your 12.5% tax liability. Myth number 2. Jewelry is an investment. Financially speaking, this is false. Jewelry is consumption. Between the GST, the making charges, and the deduction on resale, it is an inefficient store of value compared to bonds or ETFs. Treat jewelry as a luxury, not an asset class for retirement. Myth number 3. Digital gold is regulated. This is a dangerous misconception. Digital gold is unregulated. It does not have the sovereign guarantee of an SGB or the SEBI regulation of an ETF. If a platform shuts down, you are reliant on a private trustee. The exit of major banks from this space should be a signal to evaluate the counterparty risk you are taking. To summarize the situation in February 2026, the easy money phase is over. The tax loopholes are closing, and the market is punishing those who panic. If you are overexposed, use the 5-25 rule to rebalance. If you need cash, use the RBI redemption window or sell ETFs. And if you are holding for the long haul, ignore the red on your screen and look at the fundamentals. Gold has preserved wealth for centuries, and it will survive this correction. The key is to act on data, not fear. Thank you for watching. If this breakdown helped you navigate the chaos of the current market, share this video with other investors who might be worried. Stay informed and make your moves count.
Disclaimer: this video is for informational purposes only and does not constitute financial advice. The market involves risk, so please conduct your own research before investing.